the major indexes, stocks broadly higher across the board today. Strong gains after what was some deep selling yesterday. The Dow actually erasing Monday's losses, and big technology outperforming today after underperforming yesterday. Well, joining me now is Aaron Gibbs, President and CIO at Gibbs Wealth Management. Aaron, it's great to see you. What do you make of today's market action, particularly that the NASDAQ rose the most, even as the yield on the 10-year yield did tick higher?
Yeah, that's interesting. It's obviously we clearly do have these days where markets don't necessarily move completely in tandem, but I actually feel it makes sense. I mean, if you look, for example, at the 10-year, it's actually lower than where it was in the spring and in early April, yet Amazon's trading lower. So, ultimately these things are playing out. They're coming in line. 1.5% still is a very relatively low level, right? And still lower than what we just saw back in March. This is still a very good environment, and I think that Wall Street has digested that we are going to see some higher inflation for longer than we initially expected, but we've adjusted those expectations and still see that there's a lot of potential value within the equity market.
And we do see the data, right, that usually a down September is followed by a rough October, and the stock market lost 5% in September. We're still not quite in correction territory, down 10% from our recent high on the major indexes, even though many people in this market would say that that would actually be healthy. The fact that we haven't seen that in about a year, we might be due for one. What does this indicate to you, the market action that we might see for this month of October?
Yeah, so good point. So right, September was a big down month, and we often do see some sort of shaking out in October if we talk about historical just patterns and trends. I think what we're really going to deal with through October is getting a better sense of reopening trades. I think everybody was sort of shocked by some of the instability, or surprised, let's say, by the instability of economic reopenings, the continued sluggishness in being able to reopen worldwide. And so I think that is going to be, we're going to be sort of holding our breath until we get a better sense, perhaps even until earnings season, which is mid-November, and really get that year-end better sense of like what's going to happen in 2022, because that's really what are on people's minds when we're talking about investors looking 12 months forward is, how are we going to handle next year? Are we finally going to reopen? And so I think that there might be a pause in October until we see the full potential of a rally.
What is the expectation for 2022? I mean, we will get earnings season, which will kick off in earnest here in a few weeks, mid-October. Hopefully we'll get some guidance for 2022, but what is sort of the coalescing consensus already for next year?
So we're looking at about 10% profit growth. So still, in normal years, it's exceptional. It's certainly, or very good, rather. Anytime you see double-digit expectations in profit growth, that's very good. And also, there's an equally, good revenue expectations. Certainly a slowdown in some cases from this year, just because we're coming off of such easy comps from the prior year pandemic, and really getting back to normal. So when investors are looking at valuations, this correction actually has made a lot of us who felt that the market was a little rich feel a little better that we have had that correction, because obviously the interest rates have been increasing steadily, though they did jump up at September. But this feels a bit more normal. Valuations at 21 times are still expensive, but given the type of growth that we're expecting over the next 12 months, it doesn't feel as extreme as it did before.
Now, I am curious. We know Washington dysfunction has had a history of causing selling and jitters in the stock market, and we still see dysfunction when it comes to raising the debt ceiling, as well as passing that infrastructure plan and the trillions of dollars that Biden additionally wants to pass in a reconciliation bill. How should investors, Aaron, be managing their portfolios, knowing that we've got three key economic items still outstanding and uncertain in D.C.?
So all of these items that we're talking about, one for the deficit, that'll be resolved. It always is. I mean, I've been doing this for much longer than I care to admit, and it's something that's continually resolved. With the infrastructure bills, regardless of what actually gets passed, it is going to take so long for that money to actually get in the system and really contribute to the economy that it's going to be well past what investors can really think about when picking stocks, because generally, you just can't predict 5 years out. So, at best, let's try to predict what's going to happen over the next, 3 to 12 months. So I'd say really focus on how it affects consumer confidence, how it affects investor confidence. That indecision it doesn't help necessarily. And so you can use that as a buying opportunity. So if it does create a little instability, it creates down days, that's an opportunity if you see long-term growth or 12-month growth within a company and a stock.
So do you think that that's priced into the market, Aaron, the fact that these trillions of dollars in spending bills and the reconciliation bill collectively that President Biden wants to pass, that still is, years, according to your calculations, in the making before that money would actually be deployed once budgets get set and it actually does pass? If it does pass, do you think that the market is pricing in that reality, or could there be some disappointment if this does not actually get passed?
Oh, I think Wall Street is pretty set because we're really looking at that like I said for 2022, and whether or not any plan is passed, that's not going to hit profits in 2022. It's really going to be 2025. So I don't think Wall Street really doesn't have to adjust regardless of whether the whole package or part of the package gets passed, because it's just not within our realm of our investment scope. And so I think that investors can just use it more as a psychological indicator. And I think that I doubt that, we're going to have a massive change in profit growth, regardless of what happens in Washington.
In terms of this upcoming earnings season, just quickly, Aaron, what are your expectations?
Well, analysts have had exceptionally low expectations for the past 5 quarters. Basically, since the pandemic started, they've massively underestimated what companies actually do, much more significantly than anything we've seen in history. And so I expect that this is going to continue, that we're probably going to see, beats of around 80%, if not higher. So about 80% of the companies should beat estimates, and they should beat it by around an average of about a 15% surprise. That's been happening for the past 5 quarters, and I don't see any big indications that that's going to really change.
Aaron, we got to leave it there. Great to get your take on quite the update for the stock market. That's Aaron Gibbs, CIO and president at Gibbs.